People were pretty upset with my bearish interpretation on Wednesday, and I've got to admit, my views have not changed much. Thursday's fade continues to reinforce the failure of the buyers, and Friday, in my belief, is the nail in the coffin. We'll talk about why. This week we get the full labor report, which can shake things up a little bit, but from what I can tell, it shouldn't be devastating. So welcome to the Trade Brigade Weekend Show, where we'll check out all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So where exactly are these buyers starting to fail? Because it's certainly not here on the SPY monthly time frame chart. And yes, Monday is the final trading day of the month, but for now we can start to take a look at candle structure and location for September. We've got ourselves a bullish looking hammer candle up here. Longer lower wick simply means that buyers stepped up near the lows. They were able to push prices back up to the opening print and of course through the opening print for range expansion. It's also noteworthy that as of right now, we're forecasting a close at a new all-time high on the monthly time frame. If we're thinking about location on the bar-to-bar count, we've certainly got a higher low as well as a higher high and a close once again outside of the previous month's range. So we're bullish here on the monthly. I'm not calling for a detrimental crash. We know, and we've talked about this on monthly charts in the past, that for a larger downdraft to really occur in the market, you need a monthly downtrend. And just sitting here at the highest high of the trend sequence is not really indicative of that, right? If we go back to the sort of great financial crisis, how many times have we talked about the double top here, finally bringing in a lower low, a lower high was set, monthly downtrend, and then the painful moment? We just don't have that on the current monthly view, so we're definitely not bearish here on the 90,000 foot viewpoint of the market. Let's take a look at the weekly time frame chart and see what else we can learn. Let's stick to candle structure and location as we typically do. In terms of structure last week, we do have ourselves a more bearish inverted hammer-esque style bar. It's got a green body, so it's not as bad as it could have been, but in the upper wick, we certainly have to acknowledge that sellers did step up, and the sellers were able to achieve a close inside of the prior week's range. If we're thinking about location on the bar-to-bar count, we do have a higher low as well as a higher high, so it's a mixed bag here in terms of structure and location. If we think about the overall context of the weekly time frame chart, we know that just like in last week's episode, the must-watch area is the previous all-time high. This is 565.25, 566, and right now the ideal weekly higher-low pullback would look something like this for trend continuation in the upward direction. We would have lows, higher lows, and the possibility for a higher low here. And as we discussed in last week's episode, the bears would start to take further control of the higher time frames if we failed underneath that breakout point, offered a lower high, and saw a weekly trend reversal. This starts to indicate look above and fail. We're not here yet, but it's going to continue to be the back pocket idea that we just have in mind if there starts to become a larger downdraft starting on the smaller time frames. Do we have any confluence out of our additional indications? Let's check in with a fib from the low here up to the most recent high. You've got a 38.2, which could still offer a higher low above this set of pivot lows there, but not great because you'd be pretty firmly underneath the all-time high, suggesting that look above and fail, correct, to get there in the first place. So that's not really ideal. If we come in from here up to the most recent high, the 38.2 is within striking distance of these structural element highs, so I would prefer to use this look here from a Fibonacci perspective if we're going to classify this as bull flag consolidation and over time look for continuation in the upward direction. Let's quickly throw on the anchored view apps on the weekly time frame, and you can see that you are getting decent confluence here with that 38.2. That level is loosely around 561.25. It's a little ways underneath that 565.25 that we really want to pay attention to on the daily time frame chart, but on the weekly, just to play devil's advocate, if the bar starts to look something like this, a weekly hammer where the wick tests that area and we close back above, I would not call that a huge violation, and I would be thinking about a weekly higher low in the overall trend count. How about our volume profile here on the weekly? Let's see what else we can learn about price action. Let's drop this thing down to something like a 6-month chart and just ensure that we're staying in the high volume node and not breaking down. The answer is absolutely. I would be more concerned if we move back down to test this area and find acceptance underneath. Now, once again, the look above and fail would really start to emerge as a threat, respectful of those volume shelves also. Let's drop it on down to a daily time frame chart, continuing to get granular here. And firstly, we'll evaluate this week's expected move. If you're not familiar with the expected move, it's this box right here, and you can check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 581.24, implying a higher high in the trend count, a new all-time high as well. And if we're contained by the lower bound, the number's 561.78, which is actually pretty decent confluence with that weekly Fibonacci we were just looking at. And in my view, this is the absolute line in the sand down here. You can see it is previous structure with the top end of this balance range. So I would have to argue that the weekly expected move is still more bullish than bearish, but I'm not fond of the price action over the last 2 trading days in last week's session. So let's take a closer look here. Let's make this larger on our screen. The trend, of course, remains in the upward direction, and we're advocates for that based on the expected move here. But as we dive into things, sure, we have the highest high in the trend count, but that was a gap up on Thursday morning session. Let's think about what that gap up implies, because it's a gap green over red. That means that anybody who's short on the Wednesday session should squeeze out as soon as the market opens up on Thursday. And the question just becomes, did that take place? The answer is absolutely not. You can actually see in the lower wick of the Thursday session, we puncture the gap close and actually had intraday a decent amount of time spent inside of this balance range right here, because the market hadn't really done anything constructive in the first 3 trading days of the week. So it was starting to look like, okay, look above and fail back into the range on the daily time frame chart, but at the end of the day, we did technically close right at the highs. So great, that means that Friday, if we open over 572, the buyers have a second chance to keep us over that level and possibly look for trend continuation in the upward direction. Again, let's ask and answer the question, did that take place? The answer is absolutely not. Friday's an inside bar completely contained within Thursday's range, but it does close underneath that 572 level, sort of solidifying, in my view, more of a look above and fail on the daily range that we have here. Now, as described on the weekly time frame chart, as long as this pullback potentially holds the previous all-time high zone, 566, 565.25, treat it as a 75-cent zone in here. That is A-OK. As long as this holds, I don't think there's a reason to be aggressively bearish on the daily time frame chart, but in the short term, it seems very likely that this pullback could be within reason early on in the coming week's worth of trade. Let's take it on down to the hourly time frame chart. We'll continue to dissect the price action and see exactly how this look above and fail started. So again, Thursday morning opens on a gap up, aggressive sell side bar to the downside, follow through on the second hourly bar, which closes underneath. You'll notice the third hourly bar produces an upper wick that rejects 572, and then we get some price acceptance in the fourth hourly bar. It's only into the end of day there's this small counter trend move with some consolidation sideways. Where overall is that relative to the entire day's range on Thursday? Well, this is where we can bring out a Fibonacci specific to that individual day's session. Notice that we technically closed right at halfback. If you're a stronger buyer and you're thinking about what you'd ideally like to see on this gap up, first thing is either a gap and go, bring us a new solid close, like let's get a green close on the daily time frame chart. Absolutely didn't happen. Second thing you'd like to see is a partial gap fill reversal. That would indicate that sellers didn't do their job. They were unable to close the gap all the way. There was no strong selling pressure. That didn't happen. Third thing might be some sort of gap fill reversal directly off the highs of the Wednesday session. Obviously didn't happen. And then more firmly, you'd like to see a close over halfback if this is going to be a stronger reversal back to the upside. That didn't happen either. We closed right at the 50% mark of Thursday's range. So that really doesn't strike me as the most constructive turnaround story off of, the top of this prior balance. And once again, on Friday, you get a second chance for your bulls opening over 572, a failure to rally and even make it to the previous day's high, and then we fade off back down under 572, closing under 572. Second to last hourly bar technically produces a lower high. So the trend is absolutely, it's still up on the daily time frame chart, but I'll continue to reinforce the idea that through these multiple days sessions, you're not seeing any excitement from buyers near the all-time high, which is somewhat concerning. You're not getting response here, even on a structure repair, the gap fill reversal. You're not getting a second chance opportunity. You're closing fairly weak. So I stand by and maintain the stance that buyers are failing. There's absolutely zero excitement. We had the Micron earnings gap up. We had the China news overnight pushing markets higher on Thursday morning. None of it could stick there. So that's my interpretation. I don't think that it's just go out willy-nilly and short the market expecting it to go to zero, but I'm absolutely skeptical of straight up continuation in the upward direction. So what do we see here in terms of the pathing? What is most likely? I would say if you're under 572, it's not unreasonable to try to set up trades that possibly look like consolidation, lower highs, and a retest, as we were talking about on the daily, to this 566, 565.25 zone. Risk reward on this might look something along these lines. I would be respectful of the Monday and Tuesday lows just because it was the FOMC high, this Thursday low, this Friday high, so on and so forth. You can see that level at 568.25. So a little bit of a hang up here perhaps, but the ultimate target would be a deeper pullback into that daily retest zone. Once again, 566, 565.25. That's what the bears want to see for a pullback. Of course, to get even more bearish, we'll bring out the red crayon for this one. The nail in the coffin that's like, okay, wow, prepare yourself for the possibility of a weekly reversal. This lower high here starts to become detrimental, and that's really just echoing the sentiment of the Wednesday midweek market update video. If the market's going to be bullish, I would continue to look for consolidation over 572. If this is happening over here, I mean, let's not argue with price. It is technically moving in the upward direction, but I'm not convinced until you get a break, literally, of the all-time high. If you get a hold in here, that's awesome, but to actually trade this and become confident into blue sky territories, it's probably needing to look something like this. And to be honest with you, we should probably map out the opening print of Thursday around 574.40. Let's go ahead and round that to a nice round number. You guys know us up in the penthouse. Round numbers only will do. So 474.40, you could probably get 474.50 if I'm being honest, but this higher low might be where I start to interact with all-time highs. But based on the evidence in hand, it really needs to show me the hourly high or low. I need to see very impressive internals, buying strength at the exchange level, if I'm going to try to participate in the upward direction. Let's quickly check in on the anchored VWAPs intraday. You'll notice that, again, it's hard-pressed to say you should go out there and short this market with both hands because you're over this gap up anchored VWAP that was the previous all-time high, correct? You're over the FOMC anchored VWAP. I mean, you are getting some semblance of support. You have hourly lows, higher lows, higher lows. Technically speaking, these are equal and higher lows. You don't have an hourly downtrend. So again, the call is not to just short this market into the ground. It's just to be very cautious about new money longs in this area, noting that buyers are not really producing any sort of meaningful price action in the upward direction. Let's check in on the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see out of the volume flows on Thursday? Technically, they're into the market. The advanced decline line is technically, over the zero line coming from trend higher zone. But one thing that I really want to reinforce here is that this reads from the previous day's close. This reads from the previous day's close. So of course, on a gap up where you're gapping green over red, the prior day's close is towards the lower third of that range. Of course, these things are going to have bullish indications. But what actually reads from the opening print? This reads from the opening print, and this reads literally tick by tick data. That's why it's called the tick. You'll notice that on Thursday, we had a bearish index score all day long. So that, of course, would not indicate any strength anywhere across sort of the broad market indications. The cumulative tick was completely flat and down. So even on the gap up where you have these bullish reads out of what apparently looks like volume flows and what looks like the advanced decline line, there's no support market-wide for trying to buy that opportunity on the gap up here on Thursday morning. Friday, as we follow it up with that inside bar, you also have a bearish index score here, as well as a bearish cumulative build here. You get a little bit of, maybe you could say, okay, it's not that bad because it wasn't a gap up that day, with the inflows from volume and the advanced decline line still technically closing positive on Friday, but not stellar reads. Again, this is not really giving you confidence intraday to be looking for longs near these all-time highs. In my opinion, another piece of evidence that supports the main thesis I've been putting forward, buyers are failing near the all-time highs. Here is the market profile. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. Overall, what do we see here in terms of value as the Friday and really Thursday session unfolds on that gap up? Well, here's the opening print on Thursday, and here's value. Here is the previous 3-day balance range right over here. Notice that the point of control closes inside of the range. Value is overlapping to slightly up. Value is not clean to the upside there. So once again, Are buyers really producing upside continuation? I would argue not really. There's not much acceptance out of that range. And even on the Friday session, you have value that's completely contained. Of course, it's going to be. It's an inside bar on Friday. But look at the point of control. The point of control could not migrate towards this upper exploration, if you will. It's certainly lower. It's not really a double distribution, but you could sort of divide it here based on the volume nodes, upper and lower. Point of control is absolutely towards the top end of this consolidation and in the lower half of Friday's range. So not really thrilled with the type of activity we've seen in the last 2 trading days based on volume profiles in their individual session. The only thing that you might carry forward here, and this is a very nuanced data point, it is not a bullish call for new all-time highs. Please make note of that. But generally speaking, overnight highs will not act as the top of any move. It doesn't have to be an all-time high. It could be a swing high, a swing low. Generally, all-time highs, swing lows, they're not going to be made in an overnight session. And technically, you did have that on the Wednesday headed into Thursday session. The regular trading hours all-time high, I would say, is unsecure for that particular reason. Let's jump on over to the NASDAQ now and see what's going on from the QQQ perspective, just because we know that these two markets have been massively divergent. Let's load up the NASDAQ. We'll go out to a monthly chart just like we did in the S&P 500. Clean drawing set here. I want to reinforce similar concepts, right? Obviously, on the monthly, we still have 1 day to go, but we've got ourselves a longer lower wick, implying that buyers stepped up off of the lows. They were able to push prices back up to the opening print, through the opening print for range expansion. We moved over the previous monthly high, so the bar-to-bar count is bullish location-wise, higher low and higher high. We've closed right at the previous monthly high, or, this bar isn't technically closed yet. One more trading day to go. We'll see where it ends up, but for the most part, this is not a devastating change out of the highest time frame monthly on the NASDAQ. Now, is it a little bit more sideways? Is it a little bit more of a threat for a possible lower high from here to here? Absolutely, and that's something that we're making note of. It's not lost in the analysis, right? So NASDAQ lower high is still something to be paying attention to, but the indication for a full-on rollover is not there yet. If we look at the weekly time frame chart, things start to become a little bit more concerning with the, again, let's stick to structure and location as we always do. We've got ourselves the bearish inverted hammer. Again, it's not as bad as it could have been. We technically have a green-bodied bar here. We're over the opening print, but we close right at the previous week's high. You do have a higher low and higher high, but generally, it's worth acknowledging these sellers in the upper wick, simply noting that you have a breakout point here, and that breakout has been fairly lackluster, right? Which is very similar to the sentiment about the buyers near the all-time highs in the S&P 500 anyways. I am pleased that there was an attempted breakout over this as the S&P was making a new all-time high. It would be an even larger red flag if the NASDAQ never got this break and the S&P was trading at all-time highs. So there's a small bullish spin on it, which is just that this break did happen in the first place, but the close of the week is not all that encouraging. Let's take out a Fibonacci here, and the first thing I want to check in on is actually from here to here, just to reinforce that as long as we're over the breakout point, as long as we're over the 61.8, the more weekly bars that close over this 473-ish zone, the more likely it is over time we are looking for a full 100% retracement, which of course is that all-time high in the first place. We do want to come in from the low up to the high, though, just to gauge this 38.2. It's very similar. It's not quite spot on, but pretty close to the 61.8 we were just looking at. And how about this one here? Much closer to the breakout point, but still underneath. I wouldn't put too much weight into these Fibonacci's. I do believe personally that the structure here is going to be more important for a possible look above and fail. I would not, again, second mortgage the house on a Fib 38.2 in structure. Is likely far more important in terms of that failure pattern there. So let's get rid of that. Let's throw on the anchored view apps here on the QQQ weekly. We're above the cluster, so you could make the argument that shorts from the all-time high, anybody who participated short in here is underwater. Buyers from this low are all above water. Buyers in here are above water. So again, the chart is not outright bearish. Oh my goodness, the chart's going to crash and go to zero. But we've got some concerns still. That monthly lower high possibly, as well as teeter-tottering right on the edge of a possible weekly look above and fail if we start to find price acceptance back down underneath this level, which, speaking of, let's firstly go, actually, before we go to the daily, let's take a look at the volume profile just to stay congruent with what we did on the S&P, because this rejection is a little bit more obvious in the NASDAQ, right? If I do something that looks like this, just because we did have more of that exploration above that we're not trading above, look at this high volume node. That is the rejection in the upper wick of last week. And if you just do something like this as a high volume shelf, we've closed right on it. So you've got a cluster of a lot of volume commitments near this level, which is fine. And I'm not calling for a collapse, as we've already said, but if we start to get like underneath this volume shelf, which might be that 475, that's that Fibonacci we were just looking at as well, if we're underneath the anchored VWAP cluster, I would have much larger concerns if the NASDAQ starts moving below 475 on the higher time frame perspective. Let's drop it down to the daily now and see exactly what's going on here. Thanks for bearing with me as these charts load up. And here we go. So first things first, weekly expected move as always. What do we see out of this? We've got the upper bound up around 497.29 if we're contained by that. It's a higher high. It's definitely a break in the trend in the upward direction. So that, of course, is bullish here, but it's not a new all-time high. We'll make note of that. If we're contained by the lower bound, it's 476.26, which is pretty much in line with the level I would use as the line in the sand daily high or low. Cannot really afford to see the NASDAQ pull back underneath this flat top breakout, this pivot breakout. You could call it a bull flag breakout from in here. As long as a higher low is found above that, I'd start to think we're okay and constructive on the QQQ as long as this turn starts to step up. If we start to see price acceptance under here, that really, I believe, would be the nail in the coffin for the weekly. Look above and fail. Here's your lower high, probably thinking about a weekly trend reversal back in the downward direction. So as of right now, on the daily chart at least, I would give credit where credit is due and say that the pullback on Thursday and Friday is much more constructive in the NASDAQ versus the S&P 500 simply because we don't have the daily look above and fail. This balance range right here, the highs of it, you can see set on the Thursday session of 2 weeks ago now, is acting as support here on Thursday of this past week, as well as Friday of this past week at 486. As long as we're above that, I mean, again, there's nothing bearish to say about the overall trend count. It's certainly still up. This is a pullback from the highest high in the trend count. Although price action might be lackluster intraday, it is a building block in the upward direction. So can't be bearish if we're over 486 here. I would start to have those concerns once again. If this steps in on the daily chart under 483, targeting this line in the sand, this would have to turn into perhaps something that looks like this. So just to sort of spin off some ideas here, could this be what kicks off a daily higher low? Absolutely. You would have lows, higher lows, possible higher lows around this zone. Maybe it's an inverted head and shoulders, probably looking to execute either on the break of the neckline or on a higher low back over 486, goodness, back up towards this equal high at 493.10. Anything beyond that, I think it's also worth pointing out, right? The NASDAQ did close this gap and reverse off of it. That's the Thursday gap up high. So don't get it twisted. I mean, it's not intraday bullish activity, but for the most part, you're still grinding kind of in the upward direction. So the shorts become difficult to pick off. The longs, if we just get consolidation up here, we're calling it again for what it is. I know we're getting a little scatterbrained here, so let's go call it for what it is. Sideways consolidation. This starts to bring in the all-time high. That would be consolidation and acceptance over Thursday's high, 493.10. All right, let's keep the show on the road with the hourly time frame chart. And we'll take a look. So the hourly trend remains up, right? You can clearly see sets of lows, higher lows, higher lows, higher lows, higher lows being built out. Here, the concern, of course, is that we have a high and a lower high happening here. So it is possible that, again, on the hourly chart, if you're looking for a bearish intraday move to unfold, this kind of, pullback here is not really out of the picture. You have hourly high, low equal low. You break down through that, you get a lower low. You could look for a lower high here. That way you can manage risk in the downward direction, something that does this. And when we get towards this daily higher low line in the sand, that's 477. I don't think I vocalized it on the daily, but that's the level. You would try to invert the risk reward because the trend is still technically up for something that does this back up towards the daily equal high, which is at 493.10. So that's really how I would look to interact with these areas. And again, the reversal might be something that looks like this, and then you're trying to long this hourly higher low from here to here, and that gets your risk reward back up to the equal high. So that's the pathing potential if it's going to be a downside pullback and hold for the daily higher low. The nuance that I want to read into here ever so slightly from the QQQ perspective is the open once again on Friday over a pretty important inflection point from Thursday. You got your gap fill reversal, which was a little bit more constructive as we've given credit where credit is due on the NASDAQ. But the Friday, again, putting yourself in the shoes of an ideal buyer, let's say that you bought this gap fill reversal, you bought 486 on Thursday's pullback. Opening here on Friday probably gives you some confidence that you're going to get a thin structure retracement back up to the equal high. The fact that Friday fades all day and sort of sets off that hourly lower high that we were just referring to doesn't really give me a huge vote of confidence for the bulls at this point in time. If this does hold, if we open in range on Monday and we're consolidating here, probably turns into a double bottom, perhaps 1 and 2, if you can get over this neckline in here, which is closer to 490. If you can get over 490, the equal high to Thursday's high is on the table, 493.10. That could be a possible bullish idea, but as we've already described on the daily time frame chart, this is kind of like all consolidation in a range, and this is where the buyers have much more of an executable edge over Thursday's high at 493.10. Let's quickly check in on the anchored VWAPs intraday here, and once again, just like the S&P 500, it's difficult to be bearish and actively looking for shorts unless these, sort of setups start to present themselves like this, where we're breaking down underneath those anchored VWAPs from the key levels that we've been using in the past. Let's jump on over to the NASDAQ market internals and see what's going on from this point of view. And what do we have on Thursday? So, as the market's breaking down, I just want to reinforce once again, this measures from the previous day's close. This measures from the previous day's close. What about the cumulative tick? Was it really roaring to the upside? Absolutely not. So sure, the structure is a little bit better out of the NASDAQ, but even at the exchange level, you're not really seeing that intraday participation as the market was trying to find its footing on the gap fill reversal. On Friday, once again, if you're a buyer, you ideally would have liked to see that squeeze early in the morning to the upside. Didn't happen, even on a slightly bullish build early in the day out of the cumulative tick. If I just sort of like maximize this, you can see that small build in the morning, and it fades to neutral by the time the afternoon rolls around. So again, excitement at the exchange level as we're trading near these highs, trying to continue these trends in the upward direction, not really seeing it. And it really, starts to get me thinking about buyers just being exhausted, buyers failing, but the sellers also aren't really putting the pedal to the metal by reversing any of these meaningful hourly or even daily trends. Here's the market profile for the nasty NASDAQ futures. What do we see? Similar commentary. Value area is here. It's not skewed towards the top end of the profile on Thursday. You can see all the time is spent lower in the session as well. Classic liquidation break shape here, lowercase b. On the Friday session, once again, value is lower, point of control is lower relative to that Thursday gap up range in the first place. Let's move, and I guess we could point out extremely poor low on the Wednesday session there, so carry that forward. If you break down underneath, and this, if we just go back over to the QQQ cash, this is going to be this level sort of in here. If you break below this 486, if you break below the top end of this balance, I would expect the test of Wednesday's low to go through Wednesday's low, and then subsequent lower highs kick off that short trade that we were just referencing, right? So even in the NASDAQ, although the structure is slightly better, not a lot of euphoric participation from the bulls at the exchange level. Let's go on over to the IWM small caps, and we'll kick it off on the monthly time frame chart as we've been doing so far. And again, acknowledging that there is still a single trading day left in September. These monthly bars can change, but for now, at face value, what do we see here? Very similar to the other indices where we have ourselves a long tail on a hammer closing, or the forecasted close is over the opening print, subject to change. This is much more of an inside bar, though, out of the IWM small caps. The most constructive thing happening here, in my view, is that this sort of cup and handle is continuing to break out. The lower wicks are finding support over the top end of this range, and we've been talking about this on the day-to-day, literally in the pre-market preps, drawing out those three different sort of tertiary zones, if you will. We're in the upper zone, so it's got to be bullish in the higher time frame interpretation monthly. While we're here on the IWM highest monthly, I do want to quickly check in on the KRE, which is offering a very similar setup. So once again, when we're thinking about small caps, in particular myself and the analysis that I do, I'm thinking about, is the market really fearful of a recession? And looking at that previous structure, I would say, no, if we were, we'd probably be trading back down towards these lows. You could say the same thing out of regional banks, right, which hold maybe some of the more toxic commercial real estate loans. I mean, the market does not seem to be overly fearful of that. Once again, on the KRE monthly, you're getting some support in the lower wicks around 53, the top end of what could be considered sort of like a double bottom here. You had a handle over the neckline. You're breaking out again and just thinking in terms of building blocks. I know it might sound rudimentary, but literally stair-stepping in the upward direction. So not overly concerned on the higher time frames here. Would it be great if we could get over the top of this large bearish bar? Absolutely, and we're not there yet, but beginning signs of trend improvement, absolutely. You finally have a more constructive monthly uptrend here starting to hold a new set of higher lows. While we're talking about recessionary maybe indications, I do want to go over the LQD, which is not trading near these highs per se, but the double bottom reversal off of the lows. You could even come in here and say maybe it's something like a inverted Man Ray pattern with your double bottom here, and then you've got a left and right shoulder. You're over the neckline. If market participants were more fearful of a recession, I would think that this instead would really build out as much more of a monthly bear pennant, bear flag, and then threaten a breakdown lower. And for an even cleaner look, you could go over to something like AGG, I think this is the Bloomberg Aggregate Bond ETF. It measures basically the same thing, corporate grade bonds. If market participants were really fearful of an earnings recession and corporate earnings drying up, oh my goodness, consumers aren't spending, why is this sort of holding its reversal pattern over the neckline in the month of September? We made new highs in the month of September. So I'm not really seeing the argument that the markets on the higher timeframes are really headed for much larger detrimental outcomes, and that really aligns with the take we had on the SPY monthly and the QQQ monthly. Let's get back on over to the IWM though, and we'll talk weekly time frame chart. What do we see out of the candle structure over here? Inside bar, not much to read into, a little bit of a lower wick, but still fading off of the highs. Kind of a neutral and balanced session, if you will. For that reason, we can just sort of skim through our anchored view apps on the weekly, still above the cluster. So it checks out as being more bullish than bearish. And as we described on the monthly time frame chart, we're sort of in the upper bound of this consolidation anyways, which is, once again, more of a bullish than bearish indication. We'll drop it all the way down to the daily time frame chart. And you can start to see even more clearly, this is the upper third, this is the middle third. I know they're not equal thirds, but bear with me, right? Come on. Here we go. There's the lower third. We're spending more time in the upper third. However, again, thinking about market relationships, intermarket relationships, what has the IWM done that none of the other indexes have done? This has been a sustained pullback through the entirety of the uncertainty in the S&P 500. If you look at the Friday session, there was an attempt to make new highs over the previous 2 days, and that promptly rejected off of this previous swing high as well. So is the IWM still divergent to the S&P 500, and is that a reason to be slightly cautious? I think the answer is absolutely, and we did touch on this in the Wednesday update video as well. I wouldn't really throw in the towel and say, oh my goodness, it's doom and gloom, markets are going to zero. If we're over this 215, which is the upper third that we've been talking about in the first place, it's the lower edge of the weekly expected move, it's the daily 50 SMA. If we're over 215, it's not the end of the world, but it does look like, as of right now, the IWM posture is slightly more bearish than bullish. It looks like this pullback could continue to test 215, and then it becomes critical that this holds if we maintain bullish stances in the S&P 500. Let's drill it on down to the hourly time frame chart and see exactly what's going on here. You can really start to envision how this turns into some sort of like head and shoulders. The right shoulder's way out there, but underneath 218.35, the door is wide open into 215. Then it becomes all about that key question of whether or not that zone holds based on the daily analysis that we just conducted. As of right now, the neckline certainly looks like a threat with this failure to go higher on Friday morning, closing back down inside of, even if you just used this, the Wednesday and Thursday as a 2-day range, you closed back inside of that range. Like, forget about the 221.75, even just use the high of Thursday's session, you're underneath that. There is an absolute failure from the buyers to push price up and over what was a pretty clear and key inflection point from these previous instances. So, as I'm continuing to put the pieces of the puzzle together, doesn't look like a stellar opportunity right now in the S&P 500 for just straight up new money longs as we're hanging out near the all-time highs. We'll quickly check in to stay congruent on the intraday anchored view apps, and you can see the divergence here quite literally. We're underneath both of the anchored view apps. Sure, you have this acting as potential support, but the whole concept of what we just talked about was maybe that we get bearish consolidation here in the immediate term, and then we look for an immediate term pullback to continue into 215, and this is where that key question is asked. Where does all of this go out the window? Where are we like, wow, it's time to rock and roll in the S&P 500. This thing is long and strong. It's just got to be this. It's got to be this, get us back up towards that 225.25, and I'll certainly raise my hand and change my tone. But as of right now, it's been a very lackluster market here out of small caps. Let's check in on the Rusty Russell internals, see what's going on from this point of view. You can see, again, we'll sort of take everything at face value. I guess the difference here as well is that Thursday did not gap up and out of the previous day's range. So we'll take that into consideration. That means that these volume inflows were a little bit more substantial. They are a bit more meaningful, seeing movement in the upward direction. However, not even close to 125 million, the substantial sort of high water mark. If you look at the advanced decline line, it is falling out of trend higher zone. The cumulative build is bearish. And then on Friday, you can see again, very lackluster activity, even more lackluster here, bearish on the cumulative build. So that excitement, you did get it out of the tick. Look at the morning tick. On Friday, you got a little bit of euphoric action. Why was it unable to hold? Well, seems to me that the buyers here, even in the Russell, are failing as well. Let's take a look over at the Rusty Russell futures on the market profile. And the big watch here is just going to be if you draw a line flat across the top, the value area is back down inside of range, even though, once again, a decent chunk of time in that morning session was spent above. So are the buyers willing to transact at those higher prices? The answer is seemingly no. Another sort of slightly more bearish data point to carry forward here. Let's go back on over to the platform and we will start running through our sector analysis. We'll see what's going on from this perspective. There we go. So first things first, weekly performance. Who was leading, who was losing, and where was the weight? Semiconductors lead the pack up 3.74%. Pretty impressive. Followed by materials, 3.08%. Impressive, but the lightest weight sector in the S&P 500. Then we have consumer discretionary up 1.89%. Not bad. I'll give some credit where credit is due. Discretionary, heavier weight, definitely more of a risk-on sentiment as well. And the technology sector is not that far behind, up 1.25% on the week. The bottom of the barrel is the XLV healthcare sector. It is third heaviest weight in the S&P, but it's also D for defensive. We have energy lagging here and real estate as well. Financials also red on the week. So keep in mind that financials the second heaviest weighted sector and healthcare the third. You're getting that push and pull, which sort of describes why the market is more so sideways. As tech tries to hold things together, the other heavier weight sectors are not necessarily agreeing. The one thing that I'll continue to reinforce here is that the structural charts are improving. There are improvements here, but once again, it's not like we have a full-blown risk-on style look. We'll talk about why. The SMH has sort of shape-shifted from everybody being concerned, myself included, about the possibility of a head and shoulders Man Ray pattern underneath this neckline. Whoa, that's dangerous, to now looking much more like a double bottom. So we've made the equal high, which I am fond of based on Thursday's gap up, but the structure, just like the broad market and the QQQ itself, isn't really all that impressive on that Thursday-Friday interaction. Seems to me that the next key watch is just that we either get a hold over 244. That's like the optimal outcome for buyers. You build this out as a flag and then potentially go for this gap close overhead. That's what the bulls want to see. But I will give the buyers benefit of the doubt if there's a deeper pullback here, and then maybe it's just a slower execution off of a double bottom, inverted head and shoulders, whatever, higher low over that key level, 244. As long as 237 holds, I would probably maintain more of a bullish stance here out of semis, noting that you have lows, higher lows, and the potential for higher lows. So this is constructive. It does look like steps in the right direction, but ideally, as the S&P is trading near all-time highs, if we want the NASDAQ to get to all-time highs, you've got to trigger this double bottom reversal by getting up and over the neckline here. That key watch is 255.70. You're just not there yet. XLB material is straight up new all-time highs. Unfortunately, it's such a lightweight sector, it's not really going to help out the S&P all that much. XLY consumer discretionary, on the other hand, heavier weight sector, more risk on. I like the continued movement in the upward direction, but intraday, you're not really getting tradable outcomes here out of discretionary. And so thinking about the overall trend, I mean, we've made new highs. We've broken out over this swing high. In theory, it would be okay if you got to pull back all the way to test that 193.50. What does that mean for the S&P 500? Probably not looking at continuation to blue sky territories, right? So keep that in mind here, that these pullbacks can impact the outcomes in the broad market itself. XLK, the tech sector, the heaviest weight sector, what do we see? Similar to the SMH, but closer to its overhead gap. You can clearly see, just like the QQQ, the attempted building blocks in the upward direction. So ideally, walking forward, this continues to put in acceptance over 224.75, and we look for the gap to close overhead. Where would my line in the sand be? It's this more firm level at 218. As long as the weekly chart holds for a low, higher low, and potential higher low, I would still maintain a bullish overall stance in the market, with caution that the all-time high participants are not really euphoric about continuation. This would certainly change my tone, and I would be much more of a bear if this was looking like this under 218. So note that pullbacks, again, have some influence, although it's not going to change these sector-level structural charts. Probably means your S&P doesn't fare so well near these highs. If the gap does close, I would be watching very closely to see whether or not we get a gap fill reversal that's intense and intraday there's a strong reaction off of 231.80, or if it's a bit more lackluster and meanders sideways, that's a more encouraging stance here, looking for continuation over time. Next up, industrials, new highs, about 8% of the S&P 500 still. Looks like we've got a little bit of a rejection stepping up here, back-to-back inverted hammers. So again, pullback's fine. The structure's not broken completely. Higher lows are A-okay. Communications, very similar story over here. This type of look is all right as long as we hold the previous all-time highs. Communications probably worth paying a little bit more close attention to. Higher weight in the S&P 500 than industrials, of course, and a little bit more risk on as well. Consumer staples looks a bit concerning here with a head and shoulders emerging, but let's think about this, sort of constructively. What would that imply? If consumer staples are not really, getting bid here for new all-time highs, as we're possibly thinking about this recession theme, think along the lines of what we talked about in IWM. If this is defensive, if this is like risk off, if this breaks down through the neckline, wouldn't that just imply that market participants aren't necessarily concerned about a flight to safety move unfolding? So posture-wise, if this breaks down but the market can hold up and we can really start to see a little bit better performance out of financials and healthcare, it would probably maintain a bit more of a bullish stance. So watching that quite closely, 82.55 is the neckline. Utilities, most bond-like sector going sideways up here as rates are getting cut. All set, upward pressure, remembering that it's also D for defensive. If it breaks down, not the end of the world. Next up, let's take a brief glance at the TLT. Bonds are pulling back. There's some profit taking, pushing rates higher. We'll see if this can hold a higher low. It's kind of do or die, actually, based on Thursday's interaction. The hammer candle looking underneath the previous day's low, testing the 50 SMA, and then closing back in range. I like this. It really is going to boil down to, in my opinion, the bond market and the interest rate market, of course. It's going to be very sensitive to the economic news that we get this week. It's going to get kicked off with JOLTS, then the ADP non-farm. We'll get to the economic calendar, but the labor report is going to have a lot of influence over what the TLT does. From a technical perspective, it looks like a great higher low. Ideally, if you're bullish bonds, you want to see this move back up towards $100.50. If you really want the markets to I would say if you want the markets to improve, you just want kind of like a slow grind in here. You don't want these large breakout bars that do something like this, because what would that imply? Rates are plummeting, likely on fears that, maybe the labor market's going to break and Jerome Powell needs to respond. So if bonds really catch a bid and there's some sort of like flight to safety going on, pay close attention to that this week, noting it's the labor report week. XLV Healthcare double top is triggering with a lower high underneath the neckline at 154. This does strike me as being slightly more bearish. It is the second heaviest weight sector, probably putting some downward pressure in the S&P, but it's also D for defensive. So if this consolidates here, wouldn't strike me as the end of the world. I would be more concerned if we find lower high acceptance underneath this breakout point at 150, 150. So not really waving the white flag yet out of healthcare, but watching very closely this week between these two levels. Sideways is fine. This is obviously bullish. This starts to become much more concerning underneath 150, 150. Next up, energy sector. What's going on? The CL crude just getting demolished, so no surprises over here. The only constructive thing you might be able to say is the possibility of a higher low, but if you just take a look at what's going on in the CL, actually, we'll do this together, to me, this just looks like totally a bear flag breakdown underneath this level. I mean, even if you're getting a retest of that, trend line to then go lower, I would not really be bullish energy companies here, and as long as you're underneath $72 a barrel, I don't think you want to be trying to find longs in the XLE, for example. So, global demand for oil, right? Getting back to that recession theme and thinking about what some of these things imply, that certainly flies in the face of what we just saw out of small caps as well as the KRE regional banks as well. So a little bit of a conflicting data point there, but I think that the sort of fundamental take we'll give in just a moment sort of puts that fear to bed, and we'll talk about why in just a moment. So real estate pulling back, no surprise, as rates cool off a little bit, or I should say bonds take profit a little bit. And then financial sector, this is important to watch. I would love to see this hold as a higher low. Doesn't look likely based on Friday's interaction here with the inverted hammer, and you could argue the opposite, right? Lower high. But for the most part, the trend is overwhelmingly up. There is still room for a higher low over 44, so continuing to watch that. It's now very closely confluenced with the daily 50. Want to make sure that that holds if the pullback does steepen a little bit further to the downside. Let's quickly check in on the ratio grid. If you're not familiar with the ratio grid, how to set it up in Thinkorswim, check out the video tutorial in the top right-hand corner. Overall, this continues to be really lackluster. You're not seeing strong outperformance of the XLK relative to the S&P 500. So is it fair to say that we have a full-blown risk-on market? I would say no, especially as your financial sector is starting to roll over here also with a more meaningful lower low. It's no longer just a pullback in the context of an uptrend. That would have been this move right here, but now you've actually set a lower high and a lower low. Not really ideal if you're looking for continued strength out of the S&P. So sort of getting back to the theme of buyers failing, or at least being tired up here near the all-time highs, this would align with that, right? You're not getting risk on here. You're not getting risk on here. This looks fantastic. We'll give credit where credit is due. And we saw that straight up move out of the XLY. So this is great, but with two of the more heavyweight sectors lagging the way they are, not a full-blown risk-on look. This is decent moving over. This going sideways is still not the end of the world, but once again, it's very difficult to look at this market and say, yep, everything's firing on all cylinders. It's time to lock and load for new all-time highs. Not the case. You'll notice here an equal high rejection starting to pull back. The next phase is a higher low. In this ratio would be constructive, more of a risk-on feel. We're just not there yet. A higher high was not really produced. It's more of an equal high. This absolutely is still suggesting a lower high, meaning that this is a flush point. Hard to say risk-on based on that. This absolutely is saying risk-on, but mind you, that's only 1 out of 3 we've looked at so far. What about fourth? Over here, we did make a new swing high. So credit where credit is due. If a higher low can be found, that would be a decent look here. This is semis versus the healthcare sector. So kind of a mixed bag, right? This is looking okay. This has the opportunity to look okay, but these two up here still not looking great. And keep in mind that these are ratioed to the XLK, the most important and heaviest weight sector in the S&P. The yen carry trade has moved in the downward direction, but if we just quickly continue to check in on the Nikkei 225, what do we see over here? A continued move in the upward direction. So the yen carry trade, again, keeping tabs on it, but not the end of the world as this market's getting juiced over here in the upward direction. You could sort of say the China stimulus likely has something to do with that. Let's continue on through the indications. Let's look at the NASDAQ relative to small caps. This going sideways here is a good indication. If this starts to uptick, I would be bullish the broad market. If it starts to downtick, not really what you want to see. That would indicate small cap leadership or a change in leadership. Wouldn't really trust it, if I'm being quite frank with you. Let's move along to the dollar. See what's going on here. I do want to zoom out to a monthly on the dollar just because I feel like we've been trading in this range for a very long time and we're just starting to break the lows as interest rate cuts are starting to step in. So the dollar moving lower, in theory, is upward pressure for markets over here. So keep that in mind. I would say the next major level on the monthly is really closer to this 97.15 area here. Let's go round numbers only. There we go. So if this does break down and make it there, in theory, it should be upward pressure depending on whether or not there's a panicked cut out of interest rates. So you want to see a slow grind here, the dollar, if you're trying to look for upward pressure in equities, right? And that's really just, you're talking about sort of the dollar's value going down and equity prices responding to that, cheaper money, basically. If you're just sideways in range, I don't really think it changes much, if I'm being quite frank. If we look at the gold contract, I'm going to go /GC up here, actually. That way we're still on a monthly. Strong breakout out of gold, and gold has been a little bit more of a concern for a lot of market analysts here. Because the dollar is not breaking down in an equal but opposite way to gold, I'm not convinced that... I'm a little bit more convinced that gold is a continuation play, if I'm trying to think of my words carefully here as I'm speaking them. I think gold is a technical continuation play of the long-standing cup and handle in the upward direction and not necessarily an overly aggressive flight to safety. Now, could it be? Could it start to signal a little bit of fear about a second wave of inflation? I think possibly, but if you look at gold relative to, I'm actually going to flip back to this chart over here, and let's just maximize one of these. And what we want to do is we want to look at gold relative to the S&P 500. So let's go GLD, and we will take a look at the SPY. And what we'll notice over here, if I just press OK, we should be good to go. Yes. Notice that this ratio is not doing anything overly aggressive. Sure, gold is breaking out in a huge way, but how is it performing relative to the S&P? I mean, it's just hardly made a new swing high here. So is it truly a flight to safety? I wouldn't really call it that. And this idea right here, this concept, I'm glad we did this live on the show, is really what's reinforcing to me that it's a technical breakout and not so much an overly large concern about a second wave of inflation, perhaps. So with that, we will move along to interest rates. You can see that they're basically the inverse of the TLT. No issues over here. Inverted ZT, is it falling off of a cliff? Not really, it's just sideways down here. So let's transition over to the Fed tracker tool and see what's going on from this perspective. This is likely to change as we get the labor report this week, so I would not read into this too much. Market participants are still basically torn between a 50 and 25 basis point cut. You're going to get more clarity as we have the labor data this week, and then the following week, October 10th, put that one on your calendars, we get the CPI release, which is likely going to start to include some of the adjusted data that takes into consideration the first double cut that the Fed really offered. So, do we see inflation reigniting? October 10th is the day where we get our answers. Let's jump on over to the calendar here last week. Let's go back a week. There we go, to recap the data. This to me, yeah, maybe we will get a wave 2 of services inflation, which we know has not really it's not decreased in the way that I think the Fed is maybe pretending that they think it has. Manufacturing was also slightly weak. That's not really great and an indication of possibly leaning more towards the recession theme. As we continue to go down, consumer confidence, not that great. Again, not the best looking indication there. But GDP, incredibly strong. 3% was the final. Unemployment claims. Let's go over to this tab so you can just see it over here. We certainly beat the expectation in a good way, and that's both on the, if we bring up this, initial and continuing. Continuing is the orange line up here. It did see an uptick, but it was less than the expectation, which is noteworthy. But initial jobless claims are absolutely falling off of a cliff. So is there really, when I think about the need for another 50 basis point rate cut, I don't see it in the data right here. And this is exactly why I mentioned in the introduction that the labor report this upcoming week doesn't strike me as something that's about to be devastating, noting that, sure, continuing claims are slightly higher, but in an overall downtrend, initial claims dramatically lower. I don't see how the unemployment rate is going to substantially move higher. I think the market's more so going to respond to the non-farm payroll and how many jobs are actually continuing to be added to the economy right now. If we go back on over to the calendar, again, this is still last week, durable goods orders came in fine, so consumers are still spending. This was flat here, but the core up 0.5, again, that's fine. And the forecast here was even for negative 2.8, prior revised 9.8. So you're still getting some spend. It's not like spend is drying up completely. Powell spoke at the conference there. There was a bunch of nonsense. And then PCE. PCE also came in kind of in line with expectations, but I don't believe that this fully accounts for the rate cut. So we'll take a look at that as the next October 10th date really comes to mind. So here we go. Let's jump on into next week. It looks like Powell will be on the mic again. Monday, 1:55. Be mindful of a little bit of volatility there. I'm certainly watching out for jolts at 10 o'clock on Tuesday. That's the first indication of labor data that we'll get. And again, I think the market's going to be more sensitive to the job openings and the NFP, not necessarily the unemployment number. The ADP non-farms will give you a preview, 8:15 on October 2nd. That's Wednesday. We'll be live in the penthouse for that. Come on out and enjoy some coffee and donuts on me. We've got Thursday, October 3rd. This is unemployment claims initial and continuing. We'll continue to watch that. And ISM services PMI. This, to me, will start to indicate what's going on with inflation. We'll see if we're getting a second wave there out of new orders versus prices paid, basically. And Friday's the full Monty, hourly earnings, wage price spiral, NFP, our jobs continuing to be added. And again, I really don't believe this should be a concern. It looks like market participants are pricing in a non-issue here as well, continuing to stay stable at 4.2 on the month-over-month read. Earnings this upcoming week, what do we see? Pretty lackluster. I would say maybe keep an eye on Nike, see how consumer spend is. Levi's might have some similar insights, but earnings season is mostly over, and we'll kick it back off around mid-October with financials coming up shortly. Let's jump on back to the platform and let's look at our risk on versus risk off indications, beginning with the TLT ratio to the S&P 500, because we're threatening this equal low. We had sort of talked about if there's a flight to safety unfolding in the TLT, if you see that quick bid, snappy move in the upward direction based on some of the jobless claims or just the labor data, I should more appropriately say, this is likely going to outperform. And if it does, breaking the highs is a concern. If it is going to break the lows, that would be an even more bullish indication for equities down below. So watching this closely, and again, I think the whole concept of today's video is that we don't really have the intraday participation you're looking for bullish breakouts, but there's nothing overwhelmingly bearish about like short this thing into the ground. I mean, if this breaks down, it's technically bullish for equities down below. Let's jump on over to bonds relative to themselves. Once again, downtrend, 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 all set with duration risk. If we look at credit spreads, they continue to roll over here after lower highs, so lower high, lower high and lower high sort of stabilizing, if you will. HYG in isolation continues to sort of offer a bit of a bearish divergence. So to me, this is a short-term aligning with the failure of the buyers over here indication that suggests a pullback would not be unreasonable. Notice that junk bonds really made more of a sideways equal high versus the S&P, which continues to grind in the upward direction. And recall that junk bonds were right for a majority of the time, right? You made this to this higher high, whereas the S&P made an equal high, and the S&P followed via that sort of move into the end of not this previous week, but the week prior to that as well, right? So that's what we're seeing out of junk, and you could do the same thing. I know we looked at the LQD monthly time frame chart, but look at the hourly time frame chart, even more of a lower high instead of just a flat high as the market has been continuing higher. This also had the correct bullish interpretation back here. So are these going to be correct and fuel the fire for the pullback over here? It seems to me that that could be the case. Let's jump on over to Bitcoin as a risk asset. It's sort of holding up. It's decoupling, if you will, a little bit. It's sort of coming unpegged from, for lack of a better term, the equities market down below. And you could even throw in something like the NDX, of course, and see a similar indication where this is continuing to grind to the upside as this is, I guess, somewhat continuing. Let me rethink my words there. Is it really decoupling as it's just going sideways back into this range and trying to get continuation? I don't think it is. I really don't think it is. So it's trying. And remembering that Bitcoin is, in my opinion, still absolutely a risk asset until there's mass adoption and mass use case. I think that this is still pretty paired quite nicely. So not fully on board with that one. Let's jump on over to total breadth, see what's going on here. Moving average charts made an improvement this week, while breadth itself out of new highs versus lows on the NYSE exchange certainly saw a slightly lower tick, but mostly sideways there. As long as we're not under zero, once again, the call is not that this market is going to break down aggressively. The call is just that being long up here doesn't look all that advantageous from a trade location perspective. Let's go over to the RSP. You are getting that higher high here on Friday. Yeah, so I would say that as long as this is pulling back and holding above, still constructive, and I would have much larger concerns if this suggests a lower high underneath, forming some sort of like head and shoulders. We're just not there yet. So I think this aligns with the idea that you're not really getting follow through, you're not getting excitement up here, but it's also not a big major short as of right now. Sort of stuck between a rock and a hard place with the S&P, if I'm being quite frank. Looking at the NASDAQ equal weight, they're basically parity with each other, so no big indications over here. How about the Dow industrial versus transports? New highs, no new high out of transports, so that could be carried forward as a bearish divergence. VIX volatility picking up off of that 15. We talked about this in the Wednesday update video. There you go. So far, so good. Looks like volatility is going to continue to rock and roll as we head towards the first JOLTS labor report. But the VVIX, the volatility of volatility, we saw the uptick on Friday. We went to 103, but what did we talk about on Wednesday? If this rejects and rolls over for a VVIX lower high, certainly could continue this grind in the upward direction. So intraday executions might get difficult, but if this rejects 103, hard to argue that the market is really fearful about uncertain outcomes here. Let's talk about VIX futures. They are in a backwardation here currently. The 9 versus 30 is in contango, and the one-day VIX is elevated right towards its key inflection point. Remember, consolidation over 1275 is more of an issue. So not all the way there yet, but I would imagine as the labor reports start coming out, this maybe elevates a hair. So volatility increasing probably results in a market that's a bit more sporadic and threatening downside. If we look at the skew, I do want to bring this up in today's episode because it did make new highs over here, and that, of course, is indicative that some folks are not all that trusting of the move higher. It doesn't, this is like, you could think of it as a, quote, black swan indicator, just noting that market participants are somewhat fearful or uncertain about the future, which I think totally aligns with buyers not really having full faith here near these all-time highs. Let's bring this back, and we will get into our core list of companies. And oops, we want this dashboard, and we'll get the show on the road. So what do we see out of Apple? Apple is in a balance range. So talk about more indecisive activity. There's really nothing to say or do with Apple until you get either this trade right here over 229.50 into 233, or this trade right here underneath 226, and that's an if and statement here, under 224.60 to close the gap all the way. I would reevaluate at the gap close and daily 50 SMA, simply noting that this zone, the gap close, is sort of the top end of this previous consolidation. So it's trying for a building block in the upward direction. Is it possible that you close the gap and then see the meaningful move? I think it's a reasonable outcome, but for now, it's really a patience play inside of this range. There's not much to glean from the hourly time frame chart other than maybe inverted head and shoulders supports more of this thesis coming out first. So watch that 229.50. Next up, Microsoft on the daily time frame chart. Not really seeing that ideal bounce off of the higher low zone, which is here at 225.25. You're seeing more of a breakdown and rejection of this multi-day balance range from the past. So the best thing that the bullish people, or the bullish players, bullish traders want to see here early on in the week is some sort of move back over 432 and then a break like this. That maybe implies daily double bottom off of the pullback level. This is like your major double bottom in force. This is the pullback higher low over the neckline from back here. So 425.25 is a must hold area. If we're underneath it, I think this starts to unravel a little bit and you get more so sideways action. And what would this mean for the broad market? Probably not stellar outcomes at that S&P all-time high. Let's drill on down to the hourly so we can see it with a little bit more detail, because I do want to talk about the Thursday-Friday interaction. Put yourself in the shoes of a buyer. I think this is always the important way to frame the market because it gets you thinking about psychology and how people will act. If you're a buyer on Thursday morning's open, what do you want to see on the gap up? You want to see a hold of 432.15. Does it happen? No, there's a lower high underneath and we're getting continuation. So are the buyers really doing what they should be doing if they're trying to defend a higher low on the daily? No. If this is going to turn into that double bottom, this is kind of what you're looking for, and then a constructive break here gets you to the highs and maybe through 440.65 changes things to say like, wow, bullish break is really back underway, but we're just not there yet as long as we're under that 432.15. Let's move over to NVIDIA, the one stock to rule them all. It got a little bit of action there on that Wednesday move higher, a little bit of follow through from Tuesday's session. However, what happened into the end of the week? Pretty meaningful pullback. I do like the hold here of 120.50. I do like the afternoon lower wick out of NVIDIA. So if this can stay over 120.50, I would be eyeballing bullish setups here on the intraday. We're talking hourly to at least make it back towards this 124. I'm not overly fond of how quick this rejection was of the overhead range. You could think of it as overhead supply. So I think there's some battle to be done here out of NVIDIA. I think that the attempt is for an uptrend to hold. You could sort of see, that was unintentionally a trend line, but lows, and higher lows. If this can hold the building block, you could just go back to thinking about construction analogies. But if it can hold the building block higher over 120.50, that's a good first step. So on the hourly, what might that look like? You probably want to see some kind of push here and higher low over Friday's high. Gets interesting to maybe buy that pullback and look for a thin structure retracement towards the 124. If you're really looking for stronger outcomes to the upside, this of course is a no-brainer. That would be over the mosquito pattern high, or I should say mosquito wing high, if you've been tuning into the pre-market preps. This of course being the proboscis of the mosquito, wing on the left, wing on the right. Yeah, sure, it's just a head and shoulders with a fancy name. I get it. Over that, maybe gets interesting if you're looking for a more concrete long because you do have a thin structure retracement overhead. So that's how I would look to participate in NVIDIA. If it does accept back in this range, I honestly am going to be hard-pressed to get overly active in here. You do have a straight-up move that maybe could come straight down, but clearly based on previous interactions out of NVIDIA, very, very choppy range. Not really thrilled about taking those outcomes. I think the best short out of NVIDIA, which heck, can you even imagine talking about a short in NVIDIA? But this kind of over here, what goes straight up, what came straight down, maybe can come straight down. That to me is the better indication of a thin structure retracement. That's under 115.75, 109.50 is the target. Currently not a top of mind priority, but something to have in your back pocket. Google has been just absolutely brutal as an intraday trade. So do with this what you will. It's been nothing but a nasty range up here. It is sort of rejecting a little bit in those upper wicks. The top end of the balance, previous support, rejection. So 164.75, as long as we're underneath it, I wouldn't be overwhelmingly bullish here, and the short trade probably unfolds on something that looks like this. But back down to the hourly chart just for some more context. Be my guest. Do what you will with this price action. It's absolutely horrific intraday. Doesn't mean it can't improve. It doesn't mean it can't start to trend more cleanly like it did in these previous instances, but I'm not holding my breath for Google. All right, so 161.50, maybe this idea. Anything in here, be my guest. This gets a little bit more constructive to the upside, but These upper wicks don't really look all that favorable. This was already a look above and fail, correct? Look above, fail. Not thrilled with Google. Next up, Amazon. Nancy, how are we doing over here? Not looking good on the pullback, right? This is a bit more aggressive than the buyers should have or would have liked. Underneath the flat top from off to our left, underneath the resistance, support in there. So under 189.25, I think that you get this sort of continued grind to the downside. Like we've been talking about, you do have a balance range off to your left where the price action has been incredibly lackluster. So ideally, this looks like this, but whether or not that happens with a clean executable setup, not entirely sure. To be bullish on Amazon, this would have to morph into a look below and fail with higher low and likely some kind of break up and over 190.85. So higher low over 189.25, breakout over 190.85 to target the top end of the range that we were just trading in. 195.75 is that number. To the downside, this first target, if we do get the lower high and Brigade Bolt sort of looking like that, this is 184.25. Next up, Metaverse. This stock is absolutely on fire. If you sort of tapped into, I don't even remember what the event was called, but they released their AR glasses. Zuckerberg is no longer really being seen as the villain. I think he's sort of had a very impressive comeback story, and the stock price certainly agrees. Breakout to new all-time highs, consolidation, accepting those new all-time highs. My preference, honestly, would be something that looks like this. Big old retest of 542.50. The only time that really steps in as a reasonable outcome is if we break underneath this shelf of support at 556.25. With Brigade Bolt, you have a thin structure retracement, then immediately changing tone, looking for buyers to step up on that major retest. I think with the potential lack of participation on the first go around, anyone who missed the move absolutely will be looking for a second chance opportunity at 542.50, perhaps. A little bit of personal bias creeping in there, a little bit, but that would be a major watch for me, just purely based on trend analysis, right? This is trend trading 101. Big breakout level, break, retest, Brigade Bolt, looking for a higher low and continuation. If you just get consolidation here, call it for what it is. Bull flag, looking for blue sky territories up and over 574. Next up, Tesla. How is Mr. Musk doing over here? So we've got to acknowledge, of course, the gap close and continuation. That is bullish. You have an inside bar on the Friday session. This swing high is probably where I think it tries to grind to, but honestly, pullbacks out of Tesla will be absolutely a-okay. Something that looks like this off of 244, or even a weekly pullback off of this major breakout level at 234.15 is a-okay at this point. If you are going to get a break up and over 266.30, I think we have to go fishing for a level together. Let's see what we can find here out of Tesla. Looks like we need more than a year's worth of price action. Let's try 4 and see what else we can come up with. This sort of swing high zone in here captures my attention, 279.75. Let's see how far away from that target would be. So that'll do it for this week. If there's a massive parabolic breakout, of course, we'll keep you updated on Wednesday. But if there is consolidation, if there is a Brigade Bolt here, that would be your next overhead target. We talked about pullbacks. We're all set there. Hourly indications. What I think is most impressive out of Tesla, and I'm glad we sort of looked at the hourly, is that this was a 2-day balance range. On Thursday, as the broad market pulled back, right, you looked into that range and closed in the range. I like that Friday gets back above. So sustained holds early in the week over 256.25, in my opinion, will be seen as more bullish than bearish, staying out of the 2-day balance range from here, which would have been the Tuesday and Wednesday session. So 256.25. Next up, JP Morgan, a grinder, an absolute slug. Be my guest if you want to trade it. It's really been doing nothing inside of this balance range here. It's been attempting a possible hourly trend reversal with these lower lows, with the lower highs trying to stack, but you did get a higher high on Friday. So it's a mixed bag sideways in here. There's still some more free air over 211 if you can get through this thin structure, but when and if we close that, remember that the daily chart is sort of, this is the threat, and you really start to build out this massive head and shoulders. A lower high here is definitely possible, so I'm not convinced that JP Morgan's going to be or give us the best trading opportunities here in the near term, unless there's a catalyst that really wakes it up. It's more so sideways and trying to convert to a larger bearish setup, in my opinion. Next up, Netflix. What do we see here? Nice, strong retest of the top end of the bull flag. Remember that this is the flag, this is the post. So as long as this hammer can hold from Friday, very nuanced, but let's take a look at the hourly. You did sweep the low of Thursday's session by a couple of ticks here out of Netflix and close back inside of this range. So what does that mean? Well, if new money sellers got enticed towards this low and did not get paid over the weekend, and if we open back in range, this is a very attractive setup early on in the week. Over 712 into 724.50 will be a watch here out of Netflix. Thin structure retracement, all-time high breakout, bull flag breakout we've already talked about. So I like the daily, I like the hourly. This, of course, would trigger a double bottom neckline break, right? So 712 top watch out of Netflix. If it makes new 2-day lows, absolutely. You've got downside on board, but for now, bullish until proven otherwise based on the daily analysis. AMD, last but not least, let's go to the daily, and then I've got 2 additional trade ideas for you. What do we see? A little bit of a hesitation before the gap from back here. I like the fact that we still have thin structure overhead to potentially retrace. So out of AMD, honestly, I'd love to see something that does this on the daily chart. I'd love to see this on the daily chart for something that unfolds to close the gap. That's 169.75, 174.50 is the gap close, and the key area of support that we pretty much need to hold is at 159.25. If you're back down underneath that, certainly more of a suggestion about look above and fail over the last 3 trading days. Here it is on the hourly, so we can get a better sense. Kind of holding the gap. So here's a takeaway. AMD, relative to the broad market, was much stronger on Thursday because there was a gap up and it did pull back, but it left some of that gap unfilled, which would just imply that sellers did not do their job, quote unquote, all the way to the finish line. So if we can stay in this range, again, AMD has relative strength, this would be the top watch. Something that does this, trying to fish for longs on maybe a full gap fill reversal, something that does this, longs with risk reward here. This sort of sets up longs with risk reward here. Those are the ideas I would be fishing for out of AMD. If it does pull back all the way to the 159.25, it's, double bottoms, and then your long risk reward is just this, back to the swing high. So that's my preference. I would change my tone if there's price acceptance underneath 159.25. Back to the daily time frame charts. CrowdStrike, CRWD, is up first on the chopping block for your 2 additional ideas. You've got yourself a monster double bottom, higher low double bottom at that. Break, retest, looking for the Brigade bolt, higher low over 274.85. Little inside bar on the Friday session. Look at how muted that range was on Friday here versus the broad market. It was a little bit more, of a solid body inside of the Thursday range. Thursday did not gap up. This is acting a little bit more so like small caps, if I'm being quite frank. But if this can stay over the neckline, I'm very interested in this possible reversal through the thin structure towards the gap overhead. We know that this was that whole debacle when basically Microsoft and CrowdStrike shut down the entire global internet system. So we'll see if we can get through that thin structure recovery. Seems like it was a one-off kind of happening, and the stock is recovering, I would say, fairly constructively. So holds of 274.85, hourly chart for a little bit more clarity. The long might be something that clears this breakdown open, clears these sets of highs. So a higher low intraday, over 291.50 could be tradable towards the bottom end of that gap. 316.65 closes way up here at 335.90. Please understand and manage expectations. I'm not talking about this happening over the span of 1 trading day, 2 trading days, 3 trading days, heck, even this week, but more bullish than bearish out of CrowdStrike based on this formation. Next up, last but not least, ORCL, Larry Ellison, the man who's basically indestructible. There's been a huge amount of commentary, based on their most recent, I don't know if it was a conference or the earnings call or whenever he was most recently public, giving an appearance. Everybody's like, this guy's 80? Could hardly believe it. And he's, if you ask him, he says, the deals are what keep me going. So Oracle, just absolutely on fire. The stock is clearly higher, suggesting bullish consolidation of this most recent earnings move. If we take a look at the hourly chart, this, of course, starting to suggest either ascending triangle from this perspective or heck, left head, right shoulder, flat top breakout, thin-ish structure retracement towards these highs. These are all-time highs, by the way. That's over 168.25, trades into 173.75. It's in play as long as this low in here holds, as long as that right shoulder is going to be a higher low, and we'll give it some leeway into 165.85 multi-day consolidation. As long as we're in there or above, that is looking good for continuation in the upward direction. So that is going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember, we'll have coffee and donuts up in the penthouse multiple times this week for our Jolt is at 10 o'clock intraday, but the ADP non-farm on Wednesday is the first one, 8:15. The show kicks off live here on the channel at 8 o'clock Eastern time. We hope to see you there live every single morning. The market is open. So we'll catch you up in the penthouse, coffee and donuts multiple times this week, as we've said. Have a green trading week, And if I don't talk to you until then, I will see you in the next one.